Increments of 100 in the price levels of what you're trading is extremely important, and this picture shows why. Not only is it important for a good support and resistance level, but it's also a psychological wait a get that picture out of here. Like I was saying, the 100 increments on the S&P 500 often act as a support or resistance level, and it's important to be careful when trading at these levels. Here, you can see what was probably a liquidity grab by blowing past a few levels. Not only does this grab stop losses one tick below 4,300, but it also would have taken out stop losses one tick below 4,295, which is another popular place for stop losses. Then, hypothetically, these stop losses are used to move the market the other way. While these levels are certainly important, let's review some graphs so we can objectively make decisions, rather than ones based on emotions and incorrect preconceptions. It's easy to show this picture to demonstrate how price can bounce off of them, but this is what happened at this price level earlier in the day. Funnily enough, if you're also human like I am, you are now looking over here to try and come up with how you could have predicted this level. At this time, 4,300 meant nothing more than any other price level. Nope. Nope. It looks like there were bounces and retests and all that fun stuff, but nothing to a degree of significance was going on. So let's go back a long time and look at what happened at these levels, and use that to objectively come to some conclusions to make us better traders. Went below 4,300 and came back up. Went above 4,400 and went back down. It looks like it was doing a good old retest liquidity grab to continue going upwards, but then it just fell through. Went below 4,300, looked like a retest for liquidity to go down, and then it went back up. Kind of the same as the last chart, except it did eventually continue up. This was a very long and boring reversal without any type of indication of when you should have gotten in. This is just messy. The first poke down below 4,300 certainly looks like one of those legendary stop hunting epic market maker moments, and it very well could have been. This is also a chart I would use if I was selling a supply and demand course. See that? I would just crop out the other side when price goes up through it without any problem at all. Okay, this is the reversal, but everything after this is just complete nothingness that shows 4,300 as just something that price movers don't care about. Another instance of a slow reversal at 4,300. Another reversal at 4,400. Also, we get yet another false retest for liquidity to push it back in the opposite direction. So, we keep seeing what looks like a stop loss hunt to send price the other way. But for as many of those as we see, we also see that just not happening at all. I could use a previous chart to say that a retest of a 100 level is a sign of continuation, but I could also use this chart to show that a retest of a 100 level is a sign of a reversal. Nothing is happening that gives me an objective advantage. Here, you see it really slow down as it gets to 4,400. It got close to poking it, but it reversed after this. Another eventual reversal. Bearish looking retest that certainly had a big move to make money on, but not if you were going for a target beyond 14 points. This is another instance where I could look at this and use it to say that price bounces at 100 levels. While it certainly does happen, it doesn't happen often enough to develop a profitable system solely based on price behavior at these levels. As soon as I start thinking I see something happening often, we get this chart. Goes through. Is it going to continue? Nope. Is it going to reverse? Nope. It's just kinda hanging around out there. There were consolidation zones, and for as many times as that happened, there were instances of it shooting through with momentum in a single candle. We've now zoomed out to a 15-minute chart from February to March. Remember, we're in a downtrend, so the current reactions to 100 levels are different from what they would have been during the big bull run of 2021. That's certainly a big limitation to this review, but that doesn't mean it's not valid. Give this a good look and gather your thoughts. To me, this reminds me of my Fibonacci video. So, let's look at every instance of when a 100 level got involved with price action and come to some objective conclusions. That doesn't mean I won't make any mistakes, so feel free to point anything out in the comments. Let me know how you like to use these levels. First one to look at shows the price pushing through it, and then it actually does a clinical retest. You can also see how the price drops down a couple points below the level, which we could assume was for grabbing some liquidity. A stop right below a possible reversal level is the most obvious place to put it. Not only is it obvious, but if you have access to seeing resting orders, you could actually see how many orders are at each level. There would be sell orders to close active positions down there, which other market participants would use to start their long positions. Here's where it gets, I don't even know, so messy. The last chart is what most channels talk about. They grab the perfect examples. What the heck were we supposed to do here, though? It pushed through a few points, came back down quite far, and then it did this a few more times in a tight range before shooting up over 50 points, or $2,500 on one contract. If anything, the market movers just kept pushing it up and down for a little while in a 20-point range. This is just a complete mess. While you might be seeing support and resistance spots, this 100 level had absolutely no relevance. You could have traded this, but these trades would not have been based on any type of structural relevance. I can put this rectangle here, but it's not like it changes anything. Scalp away and grab smaller moves, but there's no 20-point structure change opportunities here. This would be the second chart image that trading channels show. We have a breakthrough, a retest, and then a continuation in the original direction. Seems simple, but it's a 40-point move down, a 60-point move up from there, and then a 120-point move down. We are not talking about a small amount of money here. So, from a multiple day perspective, this looks easy. But this happened over the course of a few days. Anybody who isn't swing trading would not have found these changes in structures helpful. And, as demonstrated by what happened before at these levels, it would just be a guess as to what might happen. Remember, we only know it's a downtrend after it happened. While some trends may continue to move long enough for us to capitalize on them, often it's too late. Then, we torture ourselves by looking back at what happened and believing that it should have been easy to predict. Complete mess. There was a push through, maybe for a liquidity grab, maybe for no reason at all. Made it seem like it was going to reverse just to crash through pretty hard again. Then, it was just weird shakes back and forth, just like it would at any other price level. At first, it bounced very close off of it, looking like it might have a big reversal, but then it dove down again straight through it, before bottoming out, coming back up, hanging around for a while, and then diving down again. Once again, we could focus on these bounces. But what about these? While there may be instances of 100 levels making it look easy to predict reversals and continuations of price action, there are way more instances of meaningless movements. To the right, I could say that this is from market makers grabbing liquidity from retail traders to push price the opposite way. Then, they did the same thing to the upside, grabbing liquidity and then pushing it down to the other side to repeat it. Who knows? Like Mark Douglas used to say, we don't know unless the people moving price tell us. Let's talk about the limitations to this brief analysis. 1. This month was in a downtrend, and the environment of the market has an influence over how price behaves. And, while these 100 levels may not give a result consistent enough for us to capitalize on, that doesn't mean they aren't important. Daytrader Next Door talks about these levels frequently, but he uses them more as targets. Price seems to move between these areas like a magnet. And, while I recognize the fact that any increment in price will make it seem like that, there are certainly many instances where it does seem to bounce off like magic. This movement up and down with all of these bounces off of 4300 on February 4th had many opportunities to make money. And someone on my server did just that. The invite link is in the description and will always be free to join. Combining 100 levels with other increments like 50 and 20 can show some weird instances as well. However, to counter that, with enough data, you will always be able to find a few instances of any seemingly repetitive behavior. With that in mind, I know that I will stay away from initiating a trade when it's around a 100 level, because nothing happens consistently enough at these levels to give us an edge. Some days, you can make money off of bounces. Some days, it'll go straight through or do an infinite amount of other unpredictable combinations. At the end of the day, we can be consistently profitable without needing to know the future. Personally, I will caution on the side of safety by not trying to predict any major movements around these levels. Everything is chaotic, but these 100 increments are especially chaotic. It makes sense why market makers and bigger players would poke through these areas just a little before reversing, but, as demonstrated by the charts, nothing happened consistently. Let me know your thoughts, and happy trading.